Oh, we heard it for months. President Trump's sweeping tariffs would fuel inflation, create price surges, hammer consumers, hardworking Americans. Well, look at the numbers. The consumer price index, the producer price index, all down, core inflation hitting post-COVID lockdown lows. The bottom line in all of this, the reinflation scare just has not happened. Meanwhile, it's Fed week, that's the Federal Reserve, with inflation tame, the job market steady, but not so hot. All the data points to an interest rate cut tomorrow, but Wall Street, no one is holding their breath because Jay Powell is clearly a political animal. And watching him cut rates so dramatically right ahead of the election last year when inflation was much hotter. I digress. What is good news is inflation expectations have come down because, anticipating inflation creates inflation. It begets inflation. And you saw it in the New York Fed survey, 1, 3, 5-year inflation expectations were lower. And then the University of Michigan survey last week, the 1-year inflation expectation was down sharply as well.
Yeah, I mean, the expectations were just wrong. And I think a lot of us knew that coming in, but we were told that we were wrong. So when we were saying that, hey, I don't think it's going to have the impact that you think it's going to have. And what we've seen is, one is the economists that have said this, Dagan, are still going to be able to say, hey, it's going to take more time for this to work in through the system. Supply chains are very complex. Inventories might have been stacked up, and they were able to deal with that. The sophistication of supply chains enabled some absorbing of costs that were then not passed on to consumers. So maybe we didn't feel all of that. By the way, those are, in my opinion, largely going to be seen as excuses. Now, what I do think we need to be watching for is going to be the earnings coming up. Because the first wave of earnings, everyone said, well, it was too soon. Right. Most of what we were seeing is a reflection of the quarter before Liberation Day. And earnings were really good, especially in what I pay most attention to, which is tech and AI. The other thing is AI is incredibly deflationary. So you're seeing companies slow hiring. You're seeing companies being able to expand their OPEX and their margins. All the while, they're not necessarily having to pass on all these costs to the consumers, and they're getting more efficient. I think this quarter, if there is any lagging inflation, you might see it in little parts. We're going to see it maybe in, for instance, consumer electronics, where you had large dependencies on China, and now you've got these goods coming. But we also have seen all the diversion. There was a lot of really smart diversion, great supply chain leaders of our tech companies here in the United States that found ways to get things through Mexico, through India. We've seen President Trump dealing with Tim Cook on this very issue. But in the end, we've built the sophistication in our supply chains. We know how to move things, and we know how to keep prices to our consumers at a reasonable level. Inflation is good. And to your point, I think Fed Chair Powell, we are at a point we need to lower rates. I think it would really fuel growth. I think we'd get more growth.
And I think part of the president's plan was never to get all of the pie, but to push for some of the pie. He makes it look like he wants everything to really light a fire under the CEOs to get it done. And even just some of the changes that you're talking about were good enough for him because it takes us away from exactly the kind of dependence where we were. Something is better than nothing. And ultimately, I don't think he was ever looking to shock the economy or create an inflation rate like Joe Biden did and do that to consumers. He knew the whole time that he was going to dial it back. He was going to get some of his pie and move on. So I think that goes back to the conversation we were just having, Brian, also that, that's the confidence the markets have in him also.
You got me distracted by pie.
Sorry.
I'm not going to lie. When you say pie, at this time of day, I get very hungry. I think there's a huge cost to, this is probably borrowing a Dagan point, but I think there's a huge cost to the Fed not moving on interest rates downward. I mean, there's the obvious cost of what it means for businesses when rates are high, what it means for consumers when rates are high, housing market. But the stinking debt this country has and the amount it's paying based on where rates are right now, the inflation data tells me, and more importantly, actually, and this is Brian Westbury, and I love his stuff on money supply, the M2 money supply data tells me we should be cutting rates because that's your like cash, checkable deposits, savings accounts, okay? Grew at 6% a year up until COVID. It's growing at, and we had no inflation, right? It's growing at 3.9% right now. So it's not growing at all relative to where it was, which tells me that that's the base level driver of inflation. It's low. I think it's time to cut rates, both for what it means for the consumers, but also what it means more broadly for the cost of borrowing, which falls on taxpayers.
So President Trump, when he was getting ready to sign the 3 Congressional Review Act resolutions to undo the electric vehicle mandates out in California, what a fantastic moment it was. And he had this stream of consciousness discussion in the White House, in the East Room. And one thing, I think it was in this moment, that he hit, but this is the brilliance of President Trump. And he went, and you know, they need to, I think this was when he said this, and you know what? They need to cut interest rates. The Federal Reserve needs to cut interest rates because given the amount of debt that we have, 1 single percentage point would be $300 billion in savings every year. And these ideas are in his brain and they come out. And he said, I stay up at night thinking about this. This is what keeps me up at night, instead of Joe Biden sleeping on a beach. And then he goes, and who sleeps in public anyway?
There is guilty on occasion, I'm not going to lie.
Pro-growth story to all of this as well as a lack of inflationary story. Very, very volatile, but the Atlanta Fed's GDP as of today, 3.5%. Next update comes out tomorrow. But the component of retail sales, the core group that goes into the real PCE calculation in the GDP report, rose 0.4%. One analyst now estimates that this puts consumer spending on track to increase by 3% in real terms in the second quarter. So we're not guaranteed to be looking at 2 back-to-back quarters of negative GDP growth that everyone assumed that we were going to, which in theory, the economists would say defines that recession.
Yeah.
If you actually see positive growth in the second quarter, that wipes out, I think, a lot of the concerns that even if there is a little bit of inflation, how much can we grow our way out of it? And the productivity gains that you've talked about totally helps that.
I think that one big, beautiful bill is going to be a big focus on its potential impact on inflation. But I think we actually have inflation pretty tamed right now. And I think that it is time for the Fed to act as a business owner in that, sitting in that chair for a minute. That would give me more confidence to invest, to hire, to expand. And I think they need to think about that. They need to think about how we are getting the middle of the market to move, not just the biggest companies with the largest operating leverage.
Somebody asked about the spike in oil. Isn't that inflationary? Not a spike that's related to a potential supply shock. In fact, it would hurt growth, not fuel inflation. That would be my take.